The Jackson Hole fallout continues. Live from New York City this morning. Good morning, good morning. Your equity market off the lows, but still down 0.8% on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Live from New York City, we begin with the big issue. An 8-minute market rout sparked by a speech from Chairman Powell.
Jerome Powell.
What Powell did.
The message from Powell.
8 minutes with many mentions of the word inflation.
A very strong and succinct speech.
Very direct, very clear.
The more hawkish tone and a more hawkish policy orientation.
It wasn't a surprise to see him really forcefully push back against the idea of a pivot.
The only surprise to me was how surprised the markets were.
This was an opportunity for the Fed to kind of recalibrate.
The market had trouble digesting that.
Jerome Powell getting up and saying what he said, and boom, down goes all the speculation.
That's exactly what Fed Chair Powell gave us.
You heard from every Fed speaker at Jackson Hole. You heard from Powell himself.
Didn't leave any opportunity for a dovish interpretation.
Promising to essentially keep rates higher for longer.
Powell did not suggest there's going to be a soft landing.
They're going to take more economic risk.
Joining us now to discuss is US Bank's Lisa Erickson and John Hancock's Matt Miskin. Lisa, first to you. 8-minute speech, $1 trillion rout. Do you believe this Fed will keep hiking rates in the face of a recession?
Well, certainly Chair Powell and all the other Fed speakers have been very resolute in their stance, saying that they continue to need to bring price pressures down. So we do expect this resolute and firm monetary policy to continue. And really, that is the reason why we have a more cautious outlook right now on U.S. equities, in addition to the slowing data that we're seeing on the growth front, both on a macroeconomic basis as well as in corporate earnings.
Matt Miskin, this is how Evercore summed it up. It would not be too much of a stretch to call this the anti-pivot speech. Do you agree with that?
We would, yeah. I mean, it was short, but it wasn't sweet in terms of that speech. And in terms of the pivot foot action there, I mean, it was a modest pivot at the July meeting, just saying, hey, the economic data points are slowing. Hey, we're near the neutral rate. But the equity market really thought it was a 180, and we don't see that in terms of a major pivot until the beginning of next year, where economic growth really slows more. So you got to find ways to play defense. Risk management's paramount, and we still believe we're in a late cycle economic environment.
The 2-year yield this morning took out the June 14 high, briefly. Do you think, Lisa, we need to retest the June 16th low?
Well, certainly we're keeping a very close eye on rates, and the trajectory really is upward, with the Fed continuing again to remain committed to its monetary policy tightening. We are going to see those short-term rates in particular continue to move up, and so it is a caution point.
Lisa Erickson, Matt Miskin are going to be sticking with us. I'm going to whip through the equity market for you just briefly. We're down by 0.8% on the S&P 500. Yields up by 3 basis points at the front end, 342 on a 2-year. On a 10-year yield, higher by 5 basis points to close to 3.1%. Taylor Riggs with us to break this down. Hey, Taylor.
Yeah, John, take a look at this. So we want to start with some of those equity markets, right? When you're thinking about sort of all of some of the ETFs even that we were watching, sort of that classic risk off trade that really happened after Jay Powell's speech, as you mentioned, 10 a.m. on Friday. It really continued Friday, and you're continuing that as well today as you think about some of the sort of biggie growth sectors that are really starting to get hit harder. All of this, as you know with me, can come back to some of the fundamentals, the rate story. We have this great terminal chart showing sort of the odds of a 50 versus a 75 basis point hike. It's actually now been slowly creeping back up, tilted more towards 75 in September versus 50. So you're really starting to see that horse race start to pick up as that date approaches. Finally, you talked a lot about the 2-year yield. I think, John, earlier we had headlines overnight saying some of the highest yields we haven't seen since 2007. I know that you mentioned a 2014 date as well. So we're really starting to see that 2-year pickup. That means that further inversion, flight to quality, safety, that is the dollar. And then, of course, gold, though a little bit weaker. We're wondering maybe if we can really tackle inflation this time around.
Taylor, thank you. We'll be catching up with you through the hour going into the opening bell. As I say, equity futures are lower, but they're off session lows. Morgan Stanley's Mike Wilson out over the weekend to start this week with a note, as he often does. basically the first half for him was all about the Fed and rates, and the second half is going to be about earnings. Take a listen to this. Chair Powell and the Fed make it crystal clear that their job fighting inflation remains unfinished. The path for stocks from here will be determined by earnings, where we will see material downside. Lisa, let me come to you on that. The path for stocks from here will be determined by earnings, where we will see material downside. Are you on the same page as Mike Wilson?
We do think it's going to be key to see how earnings evolve in the second half of the year. Our base case is that we are going to see continued slowing growth, not necessarily a full-on rout, but again, there are risks to the earnings front. And so our reason for our modestly cautious stance is really on the back of the fact that we've had a first repricing, which to your point, has been really cutting down those multiples as interest rates have gone up. But again, there's risk in the second half depending on how far earnings do deteriorate on a second repricing that's really reflecting those potentially diminished growth prospects.
Matt, if the first half was about rates, do you think the second half is going to be about earnings?
We agree, and what we're trying to do is really find those companies that are going to have earnings and margins hold up the best, better balance sheet businesses to mitigate risk around this earnings contraction. So higher quality U.S. equities, more defensive, less cyclical stocks. So trying to lean into those parts of the market here to mitigate the earnings drawdown.
Chairman Powell was leaning in a massive way. Just went through a selection of quotes from Chairman Powell in that speech. I've read that thing 3 or 4 times. Estimates of longer run neutral and not a place to stop or pause. Chairman Powell pushing back against some of the conversation about that. He went on to say restoring price stability will likely require maintaining a restrictive policy stance for some time. Again, it's about raise and hold for a while. He said the following too. The historical record cautions strongly against prematurely loosening policy. Matt, that feels like a direct pushback against 2023 rate cut pricing. It's done a great job of establishing the reaction function about the present in the moment where we are now. You can disagree on the forecast if you like, Matt. Would you go with it that you think a situation's going to develop that this Fed will be cutting rates next year?
Well, I think you even talked about on Twitter, what the Fed said this time last year at Jackson Hole, right? And it was the complete opposite script. It was inflation's going to be transitory. We're not going to tighten that much. We're going to be slow. And then this one, they've done a 180. And now we're saying we're not going to be cutting rates. And it's unfortunate, but this is, trying to use forward guidance the best you can, trying to lean against the market the best they can. And they need to keep financial conditions tight. So that's what they're trying to do. But in our view, they're going to be cutting next year. The front loading of rate hikes, using 75 basis point rate hikes and slamming on the brakes. We're not even talking about QT yet. I mean, we're going to have QT now at $95 billion a month. This is all going to have to switch as growth slows into 2023.
Matt, just on QT, what's the kind of impact you're expecting?
Well, eventually, we think the 10-year Treasury yield actually falls on it. And we did all this analysis in 2018, but it's going to absorb liquidity. It's just going to drain liquidity out of the markets, and it's just another form of tightening. Dudley has said about $500 billion off the balance sheet is worth 50 basis points. So you're doing 75 basis points, 50 basis points a pop, and then you're going to do another 50 basis points in about 5 months' time. That's a lot of tightening in the system, and not to mention higher gas prices, higher everything prices for the consumer. There's a lot of tightening in here that we think is going to show up in the economy, and you got to be thoughtful about risk management given this backdrop.
You're not alone on the QT point. We heard that from Mike Wilson of Morgan Stanley last week, alongside Bob Michael of JP Morgan Asset Management as well. Lisa, what are your thoughts on the kind of impact that QT is going to have in the coming months and quarters?
QT is certainly something we're going to want to continue to watch. We really just haven't been through this kind of period before. We've been used to years really of, again, loose monetary policy and or actually supporting the bond market with liquidity. And so as that liquidity comes out, we certainly expect to see some impact on volatility in fixed income pricing. And again, it's really the equivalent of additional rate hikes. So we're going to have to watch the cumulative impact on really what happens with the economy.
Lisa, you heard what Matt just said there about the new consensus. The old consensus was transitory. I think we've got to talk about the new consensus, short and shallow, that if we get a recession, it will be mild. It will be short. It will be shallow. Lisa, 12 months ago, it was all about transitory. Right now, the quote now is short and shallow. Should we be pushing back against that view?
We do believe that if we get a growth slowdown, hopefully it will be more mild. And that's really on the back of the fact that we came into this particular period with a relatively strong consumer and relatively strong corporate finances. However, depending on how inflation continues to resolve, how quickly it comes down and how durably it comes down, as well as the presence of any potential other shocks on the economy, again, it's really hard to say how this is going to play out. And really, that's partly what the markets are reflecting right now, is really the level of economic uncertainty at this point is high. And so there is more reaction to every data point that comes out.
Matt, final word on that.
You know, it's setting up tail risk. And what we're looking at is we haven't had kind of a financial spillover effect yet. They're trying to break something. The Fed is trying to break something. So again, risk management paramount, thinking, thoughtfully of where to manage, put risk on the table. You got to have high conviction in a portfolio. And so that's what we're trying to do is again, think about income, higher quality equities, and good places to allocate capital as we weather this volatility.
Matt Miskin, Lisa Erickson, sticking with us going into the opening bell. Some of the quotes that came out of Jackson Hole, some really powerful stuff about the number one priority, bringing down inflation, and the price they're willing to pay, lower growth. Whether it was Chairman Powell who said this, reducing inflation is likely to require a sustained period of below-trend growth, or the ECB's executive board member, Isabel Schnabel, saying this: even if we enter a recession, we have basically little choice than continue a normalization path. Just think about that. Futures down about 0.7 on the S&P. Let's get you some movers going into the open. Here's Katie.
Hey, John. Well, it's not a pretty picture pre-market, and a lot of that pressure is coming specifically from tech. If you look at some of your most traded names before the bell, it's Tesla, it's Apple, it's Nvidia, all falling after Powell made it very clear on Friday that this Fed is staying the course. You also have Peloton, too, under pressure. This stock can't catch a break. Down another 2% pre-market. It's now officially raised all of its COVID gains. There are some hints of green, though. You do have Pinduoduo shooting higher after what analysts are calling very strong earnings. That's a quote. Bed Bath & Beyond, too, also getting a bit, up 8%. I couldn't tell you why, other than maybe speculators are out, but that's not the case in crypto. As you can see there, you have both Marathon, that's a miner, and Coinbase taking a dive. That says Bitcoin hovering around 20K. It was a rough weekend for Bitcoin, John.
Just a bit. Katie, at least we get the weekend off. I'm not sure why they arranged that market to trade 24/7, but I want no part of that. Katie, thank you. Coming up, ramping up the hawkish rhetoric over at the ECB.
It's action time. The next step will be a significant move in September, depending on the incoming data.
That conversation, up next.
The reality is that we have excessively high inflation globally. The next step will be a significant move in September, depending on the incoming data on the economic and inflation outlook. It's action time, and our mandate is price stability, and we will work accordingly.
The ECB, following the Fed's lead, ramping up the hawkish rhetoric ahead of Wednesday's inflation print and setting the stage for another rate hike at next week's ECB meeting. Our team coverage starts right now with Lizzie Burden and Taylor Riggs. Lizzie, is it going to be 50 or maybe even 75 from this ECB?
Well, Danske Bank is now saying it'll be 75 because of all those hawkish comments over the weekend at Jackson Hole. We had Isabel Schnabel saying that the ECB needs to act forcefully, even despite the recession risks. For me, more interesting than that is Olli Rehn, because he's a little less influential, but usually more cautious. You heard him saying it's action time. And then you had Francois Villeroy as well saying that they need to act in order to avoid being unnecessarily brutal down the line. You're actually just hearing from Chief Economist Philip Lane right now in Barcelona. He's saying that September will mark the start of a new policy phase, although he has said that smaller hikes are easier to correct. But basically, the message is that they need to control inflation expectations. They also need to support the euro, because you've seen the euro slipping below, flirting around euro-dollar parity recently. But we'll get more data this week on inflation, jobs. If the inflation print beats expectations, expectations, or if the labour market's tighter than expected, that will make 75 basis points more likely. But there is, of course, the consideration of what does Italy do if borrowing costs go up drastically. So Bloomberg Economics' base case at the moment remains 50 basis points.
Taylor, let's talk about that data later this week. What are you focused on?
Some of the data, of course, coming out earlier this morning, John, when you think about an equity market in Europe trying to find its footing, some of the Ursula von der Leyen comments, of course, saying that the European Union planning some urgent steps to try to push down some of those soaring power prices. That's, of course, as you're just hearing Lizzie talk about, some of the inflationary pressures underway. Now, we don't have exact details of what that EU intervention would look like, but we're hoping to get a detailed plan as soon as this week. So that's sort of the cross-asset picture, of course, that you're looking at there. When you take a look at, well, some of the terminal charts that we have here about sort of the massive rise in power prices, how it's sort of been impacting some of the inflationary data points. That chart really points it out there. And of course, if you take a look at the next board that we have, just showing out the terminal data points in December, January, of course, that's when it's coldest, as you know. So really highlighting those contracts as we think about also the contributions to inflationary data underway.
Taylor, who wants to tell Lizzie Burden the Bloomberg surveillance rule that if you stand in front of a piano, you've got to play it? Should we share that with
so
Lizzie
out
now?
of tune, John, you don't want to hear it.
Lizzie, next time, Lizzie Burden, Taylor Riggs, to you both. Thank you very much. I want to pick up on that quote that I mentioned a few times this morning already from the ECB's Isabel Schnabel. And Lisa, I want to come to you with a question on it. The ECB are telling you this, that even if we enter a recession, we have basically little choice than to continue our normalisation path. What does that mean to you about how you want to allocate, if at all, to Europe?
We actually recommend a cautious stance against international and European stocks as well, and it's for the reasons really that we're talking about here. You have Europe in a very difficult situation where they are also seeing some growth slowing, and yet the underlying inflation is even to a greater degree an issue there as opposed to in the U.S. because, again, of the proximity to the Ukraine-Russian conflict and the impact that has had really on their energy prices. And so the ECB is really in a tough spot. They need to continue to respond, again, to those price pressures in a forceful way, and yet be cognizant of the fact that, like in the U.S., they have growth slowing.
Danske Bank have this to say, and they agree with you, that's for sure. European equity markets are very cyclical. Company earnings are heavily impacted by the overall economy. Makes the current outlook bleak. Bleak is their word. Now, Matt, they're not alone. I hear this from everybody. We're throwing a lot at the European economy right now. It's brutal, it's bleak, pick whatever word you want to go with. Matt, I'd be asking at this point why the euro then is not weaker. Never mind parity, but much lower than that. What do you make of that? There's two ways of looking at this. Yes, there's a load of bad news and we broke through parity. There's another way that we're throwing a lot at this currency and it's still in and around parity.
Yeah, it's a fair point. And I mean, the ECB is now starting to tighten and actually raise rates. And so it's, getting a modest bit here. And I think there's been an underappreciation of the ECB actually tightening policy. But to be honest, stepping back, I don't get it. If you've got an energy crisis, supply shock, raising rates isn't going to help that. It's not going to help lower natural gas prices. The fiscal side, that was some of the headlines this morning, too, was on the fiscal side saying, hey, we've got to actually deal with this energy crisis. I think that's the way to go versus raising rates and putting more pressure on the economy as this energy crisis really unfolds. So, they're in a tough position. We're watching Italian yields, the spreads there relative to German yields, and just trying to find out when are they going to use the anti-fragmentation tool, trying to get that spread down. And to us, you just got to be careful around there. The only positive I would say to the European equity markets is there is a lot of energy exposure and materials exposure and inflationary assets in the indices. And if inflation is high, those companies are passing on the prices. So there's a lot of bad news baked into these, and you just got to be careful when everybody's on one side of that trade.
Matt, do you think the energy trade still works in the face of recession? Jeff Curry and the team over at Goldman pushing the idea that it does. Classic late cycle situation, demand above supply. Do you think it does work?
We think eventually it rolls over. And when it rolls, it's going to be hard because it is a high beta part of the market. Right now, you just got to be careful. And we would, put stop losses on that and trim into strength. We do on the value side see our strategies overweight energy relative to financials and other parts of the value complex. And they've been doing well there. And I think, though, they're right-sizing that position and making sure the portfolio doesn't act like one big energy play, because it is so vital to the performance of the value space right now.
Elisa, that's what I heard from Andrew Sliman over at Morgan Stanley Investment Management this morning. He told me and the team that you should be selling those energy winners. Use them to fund some of the beaten up parts of the market. That's what you want to do. Is that what you want to do?
We're really in a neutral place on energy right now. On the positive side, what you see with the energy complex is that certainly capacity relative to demand on a more secular basis is low. Certainly, as we continue to migrate even to renewable energy, we continue to need some of those more traditional forms really to support that transition. However, as Matt was pointing out, with growth potentially coming down and subject to even potentially worse shocks, that's not the best place really to focus on the energy sector. So we really believe just staying at a more neutral position at this point makes sense.
Lisa Erickson, Matt Miskin, to the both of you, thank you. Going into the opening bell, about 7.5 minutes away. Equities down by about 0.7% on the S&P 500 after a tidal wave, an avalanche of hawkish speak coming out of Jackson Hole. Up next, the morning calls, and later, Canaccord's Tony Dwyer anticipating a retest of the June lows. Tony joins us at the opening bell. The good news for the equity market bulls is that stocks are off the lows and bond yields are off the highs. Your equity market down about 0.75% on the S&P. The Nasdaq was lower by more than 1%. It's now down 0.9%. The bond market yields very close to 350 at the front end early this morning. Your 2-year through the highs of the year, 341.71. It fades a little bit now, just up 2 basis points on the session. That's the price section. Here are your morning calls. We kick things off first of all with KeyBank downgrading chemical stocks, including Dow to underweight, highlighting the group's significant exposure to softening commodity prices. Next up, Argus upgrading AstraZeneca to buy, $75 price target, expecting recent regulatory approvals to fuel upside. That stock is unchanged on the day. And finally, Baird cutting its Peloton price target down to 20. This stock all over the place, expecting a challenging macro environment to weigh on next year's revenue growth. That stock is down about 2% to $10.40. Coming up, Canaccord's Tony Dwyer on why it's not time to buy this dip. That opening bow just around the corner with your equity market down by 0.75% on the S&P 500. Bond yields a bit higher at the front end by 2 basis points on a 2-year to about 3.42. On a 10-year up 4 or 5 basis points to just short 3.1%. The opening bow this Monday morning. Up next. 23 seconds away from the opening bow this morning. Good morning to you all. You'll hear a lot about June. On Friday, we heard a lot about June, the biggest one-day drop since June, the biggest weekly drop on the Nasdaq since June. And this morning, your bond yield at the front end taking out the June high. Your equity market this morning down about 0.8%, off the lows of the session on the Nasdaq down about 0.9%. Let's the opening bow, switch at the board and get to the bond market. You'll notice the move has faded since this morning. Yields were higher, much higher, now up just 4 basis points on a 10-year. So let's call it 3.08% on a 2-year. High of the session, 348 right now. 341 and fading fast. In the FX market, euro stronger, just about above parity on euro dollar, positive 0.4%, and crude doing okay, up a little more than $1, up 1.2% on WTI to $94 and around about 15 cents. Let's get you some moves around the opening bell. We can do that with Katie Greifeld. Hey, Katie.
Hey, John. Well, like you said, it's tech that's leading the early losses. Tesla is the poster child of that. You have the EV maker off by about 1.8% or so, coming back a little bit as we just kick off trading. Interestingly, you have the financials not doing too hot either, even though you do have yields higher, the yield curve steepening a little bit in very inverted territory, not giving any sort of bid to Bank of America. The energy names, it's give and take. You have NextEra Energy down by about 1.2%. It's one of the largest generators from natural gas in the U.S. You do have Exxon, though, getting a little bit of love this morning, up about 0.5%. Let's also talk about some of the meme stocks, because I can't really find a narrative here. You do have Bed Bath & Beyond higher by over 6%, but then you look at some of the originals, GameStop, AMC. GameStop up a little bit, AMC not so much. So again, not really a narrative there, but it is very hit or miss in the meme sector of the market, if you want to call it that.
Katie, I thought the whole point was that you don't need a narrative.
I'm trying for you.
Katie, thank you. We appreciate the big try. About 90 seconds into the session, equities down about 0.8% on the S&P. As Katie said, big tech very much under pressure now, and over the last week, we're down about 1 percentage point right now. Another day of declines, following its worst day since June, back on Friday. Taylor Riggs has more. Hey, Taylor.
Yep, John, the sell-off continues, as you can see, with some of the bigger of the big tech, of course, some of the mildly underperformers relative to the S&P, though it does look sort of red on the screen anywhere you go. I think what's interesting is we pulled some of the CFTC data from Friday, which shows out some of the weekly positions. Now, that is for data as of Wednesday, but it is showing that there was some change in the short positions, closing out some of the shorts, fewer short positions in the NASDAQ E-mini futures, for example, by about $6 billion, 25,000 contracts. Now, how much of this was in anticipation of Jay Powell speaking on Friday and just wanting to be more hedged when you think about not wanting to be in this market with a full position underway? But it also could be, well, some of the rate hikes, right? And if you think that rates are going higher, maybe you don't want to be in some of those long duration assets. That's really been the narrative around technology. We know that coming off of COVID, it being the big defensive play. How do you then think about this with yields rising in the way that that impacts that present value?
Taylor Riggs, thank you. A lot to think about there. Right now, we're down about 0.75% on the S&P 500, still up by close to 10% off the June 16th low on the S&P 500. A little bit earlier this morning, alongside the team, Tom Keane, Lisa Bravitz on Bloomberg Surveillance, we caught up with Morgan Stanley's Andrew Slimmon on the equity market route. Take a listen.
We've had a big bounce. High risk came back in the market very quickly. And I think that's, that was a dangerous sign. So Jerome Powell getting up and saying what he said, and boom, down goes all the speculation that had come quickly back in the market.
Katie's back with us. Hey, Katie.
Well, if you look at Bitcoin, it's fighting to stay positive, get positive here, hovering around $20,000 a coin. But let's take a look at some of the crypto equities, for example. This group really tends to trade in lockstep. You're seeing that this morning. Again, you do have some of the miners outperforming a little bit. If you look at Marathon, if you look at Riot, if you look at Coinbase, though, I mean, that has a lot of idiosyncratic problems. That crypto exchange there, it is off by about 1%. If you zoom out just from today's price action and look at where Bitcoin has been since its peak, it's down over 70% from early November 2021. That was a long time ago. The NASDAQ 100, for example, your big tech stocks, down 22% over that period, just for some context. So that's a pretty ugly chart, but let's add some lines to it. I love this chart because it really shows that Bitcoin, it's been trading in $10,000 intervals for a long time now. This is a market that loves round numbers because there's not really any fundamentals, as you know well, John, and it really looks like a staircase. You did see Bitcoin break above a little bit, sort of as we were thinking about that Fed pivot, but we are back to that $20,000 level. It remains to be seen whether we go to 30,000 or we go down to 10.
You know you're going to get some love mail for that, right? This is a market that loves round numbers because it doesn't really have any fundamentals. I'm literally writing it down. Katie, thank you. Canaccord's Tony Duarte looking for the Fed's next move to guide risk assets. He writes the following. The worst of the bear market is over, but the macro backdrop of yield curve inversion, real liquidity and further Fed rate hikes argues for a test of the low based on increased likelihood of recession. Where we go from here should depend on the Fed. Tony, I'm pleased to say, joins us right now. So, Tony, walk me through what you understand is the message from the Fed and what it means for a retest of those June lows.
Well, so as you know, thanks for having me, John. The inflation break-evens were starting to rise again. So it was clear that the Fed had kind of lost control of the narrative that they had inflation in hand. So that is where I think the very short and very clear, if you read the Fed minutes, that's one thing, but to listen to the inflection in his voice made very clear that the Fed is going to be aggressive here. And ultimately, I agree with a couple of the other folks that you've mentioned in that it's not about the Fed rate hikes at this point. I don't think to curtail the valuation of the market. I think it's the impact of the rate hikes and what it's going to mean to economic output that is going to be the cause for this indigestion that we're going to be in.
So you're in the Mike Wilson camp, Tony, and for those just tuning in, this is the Mike Wilson camp right now. He said this: Chair Powell and the Fed make it crystal clear that their job is fighting inflation. It remains unfinished. The path for stocks from here will be determined by earnings, where we can still see material downside. Tony, his message is the front half of the year was about rate hikes. The second half is going to be about earnings. As you point out, the fallout from some of this tightening of monetary policy. Where are you on earnings then, Tony? What are you expecting? And do you think this market, do you think market participants are appropriately anticipating what you expect to be happening with earnings?
Well, John, you have a Fed spiking interest rates in a historic way into a generationally levered system with bloated inventories and dropping and slackening demand. That's not the recipe for higher earnings. And you know, Mike, I think, has it right on term. There's not a lot of us up until Friday saying that the market wanted to rip higher. Remember, everybody was kind of on the momentum trade, and when you've recouped half of the blah blah blah, that stuff. What it comes down to over time. And I agree with that. Remember Marty Zweig used to say, don't fight the Fed and don't fight the tape. And basically, you've got to fight one or the other up until Friday. But ultimately, our whole core fundamental thesis since you and I have known each other has been the market correlates to the direction of earnings. The direction of earnings is driven by economic activity, and economic activity is driven by money availability. And people are used to me being very bullish and very excited, and we haven't been this entire year because the money availability has been shrinking. When you look at the percentage of the yield curves that are inverted, people like me, they love to come on and talk about their favorite yield curve. Let's take all of them. My friends at Ned Davis came up with an indicator that when 55% of them, of the possible yield curves are inverted, you've gone into a recession each time. So you don't have to pick your favorite one to cherry pick the data. Ultimately, when the Fed raises rates like this, John, it's not great for economic output, which means earnings assumptions for next year for 244. It would take an extraordinary drop in rates by the Fed to make that happen.
Tony, I asked the Fed last week, I think it was Patrick Harker of the Philadelphia Fed, after 12 months ago when we were all whispering transitory, screaming transitory, are they making the same mistake again by thinking about a recession as short and shallow? That seems to be the buzzword of the now. I mentioned that last week. I've mentioned it a couple of times already this morning. Tony, what do you make of the new consensus? Are you uncomfortable with how comfortable people are around this idea that if we get a recession, it will be short, it will be shallow, it will be mild?
Okay, so John, this is where I think I'm a little bit different than some of the guests I've heard. The Fed is clearly tightening. Like I said, it's not a great setup, in a generationally leveraged system. People want to go back to the Volcker era. In the Volcker era, you had a generational low in debt to GDP versus today we have a generational high. So the idea that you're going to shut down the economy and not have a dramatic impact or spike rates and not have a dramatic impact on earnings makes no sense to me. But here's the interesting part. What if by the end of the year, remember, we're in an election year. So what if by the end of the year, inflation's coming down, all signs in the core PCE, all the PCE last week suggest it is. I think people are looking at the wrong thing. I think they're looking at inflation instead of the unemployment rate. When you get close to the election and you're seeing a meaningful move higher in the unemployment rate, which is driven by the National Federation of Independent Businesses hiring plans index, it leads it by 4 months. So we're expecting a pretty meaningful increase in the unemployment rate going into the end of the year. So you could have a very different narrative in an election year if you're having much better trending inflation, but now you have a spiking unemployment rate. Right now, the small and shallow folks is because you don't have that actual economic data yet.
Tony, if that's the backdrop, is that a buy?
John, if we get toward the low, so our plan, unfortunately, people like me change so often. Our plan this year has not changed. We expected a tumultuous first half on the transition of monetary policy. Then when you're at 16 times down 24% with a still positive nominal growth rate in the economy and a historic level of pessimism, it's set up for a summer rally. But then you got to deal with what we've been calling the fall, the reality of what happens when the economic data actually begins to weaken. Not the idea that it might weaken. That was the first part of the decline. But actually weakening is the second. Two very different fears. The fear of what might happen and the fear of what's happening. And I think it's that fear of what happening is you pull back toward that low. What I'd like people to do is look at the advanced decline line, look at the internals of the market, look for positive divergences. Right now, I don't think you have to make a bet. We'd love to come on and talk about making a bet. You don't have to make a big bet. So our advice to the institutional investor is to stay light and what I call light and tight. Hug the benchmark. It's a time to not get hurt. And if you can reduce exposure, have lesser growth exposure, we've been recommending that as well.
Is that the Tom Keene triple leverage cash fund? That's what it sounds like.
I remember last week he told me the most bearish he's ever heard me, which isn't true. But
for once, that's working out.
John, this isn't. We really complicate this. It's not a complicated game. Do you have money to buy stuff? Do you have money to do stuff? Do you have money to invest in stuff? And that was coming out of the pandemic, a historic surge in that money for all three. And now you have a shrinking of it. And I think you have to pay attention to that until there's signs of some real change. Not, oh, they might be softening, pivot, or whatever they think they're doing. No, now it's black and white. They're very aggressive. So if they do start to soften their tone, you know it's a pivot. You don't have to guess about it.
Well, it's not a pivot right now. Tony, you're going to be sticking with us. Tony Dwyer, in the equity market, relative to where we were earlier this morning, things are better. We're down 0.4% on the S&P. On the Nasdaq, we're only lower by a little more than 0.1%. And I imagine contributing to that move is the fact that the bond market at the front end, that move has faded quite a lot. We've gone from 348 at the front end in the Treasury market to about 342 on my screen right now. We need to talk about energy as well. Europe grappling with surging prices.
The skyrocketing electricity prices are now exposing, for different reasons, the limitations of our current electricity market design.
And why one letter from Secretary Granholm might make things a whole lot worse. That's next.
The skyrocketing electricity prices are now exposing, for different reasons, the limitations of our current electricity market design. It was developed for under completely different circumstances and completely different purposes. It is no more fit for purpose. And that's why we, the Commission, are now working on an emergency intervention.
Happening moments ago, the EU planning on emergency intervention to alleviate soaring power prices. The Commissioner, President Ursula von der Leyen, offering little detail with a growing chorus of member states calling for a price cap. Meanwhile, US Secretary Jennifer Granholm urging oil refiners to curb their fuel exports. Team coverage starts right now. Bloomberg's Emily Wilkins down in D.C. alongside Taylor Riggs here in New York. Emily, what is Secretary Granholm up to, and did the State Department know, and did the White House know?
Well, Secretary Granholm has been in discussion with these refiners for quite some time now. The concern is that oil and fuel reserves along the East Coast are at historic lows right now. And basically what Secretary Granholm is saying in this letter is going to refineries and saying, hey, we hope that you guys will realize this issue and that you will focus more on making sure that fuel is going to American consumers, especially as hurricane season gets started. That tends to hurt refineries out there. At this point, though, they're not doing any drastic measures. They're not putting in any export controls. They're not going to be limiting supplies. So it's really up right now to these oil refineries and major companies as to how they're going to be thinking about selling gas and fuel in the next several months.
So stockpiles of gasoline and diesel at historically low levels in the Northeast. And this letter, just to give you a snapshot of it, it is our hope that companies will proactively address this need. And if they don't, this is what Granholm had to say. The administration will need to consider additional federal requirements or other emergency measures. So essentially, you've got the Energy Secretary asking refiners to put American consumers before maximising profits and supplying a fuel-starved European economy. Taylor Riggs, you can see how this might get complicated for the Europeans.
Indeed, John, especially when you're thinking about European versus some of the U.S. nat gas prices, which really is showing sort of the difference in just the magnitude, and dare I quote Tom on a log chart, right, of how quickly things are rising. Of course, here in the U.S., crude is higher and our nat gas futures are only down to about 9. So you compare that and you go overseas, take a look at the terminal chart just to fold this all in together with some of your European expertise. The tenfold increase that we've seen over in Europe, whether it be the Dutch price or some of the UK prices as well. just soaring now, of course, following a little bit on that news that we were talking about, some of those comments from Ursula von der Leyen about maybe some price caps. We'll wait some further details about the actual numbers and actual specifics about that. But that at least is helping to fold in some of the news today, despite, of course, back here in the U.S. doing what we can, looking at nat gas production hitting a record. This is data as of May. But again, we don't really have sort of the large infrastructure to increase this, let alone think about some of the difficulties in the exports. But certainly some differences when you think about U.S. versus Europe.
Taylor, what do you think the fallout would be if the United States banned or even curtailed energy exports? It would be pretty messy for the Europeans.
Well, and I just, at least here, John, if I think about my focus on the U.S. side, inflation has been the concern, particularly as we head into the elections, that I think the focus, whether you like it or not, has been here on the American consumer and the inflationary impacts here at home.
The difficulty, of course, is reconciling that, the economic tension at home, with the goals abroad, the foreign policy effort, and to get the Europeans on the same side when it comes to Russia. Emily Wilkins, Taylor Riggs, to the both of you, thank you. Tony Dwyer back with us. Tony, consumers in Europe are facing a tough time. We know consumers in America are. Yet I'm told repeatedly, Tony, that consumers in America are still strong, resilient. Do you agree?
Well, they've been resilient, but most of the data that people are using to suggest that are end of March data. So when you actually think about what's happened in the equity market and fixed income markets, and by that I don't just mean the S&P 500, John. As you know, some of the software names and the new issues that have come out have absolutely collapsed, and a lot of wealth, perceived wealth, has been lost through that via options and other things like that. So I think what we have to do is wait to get the updated data. But at this point, that whole conversation about energy remains in place here. And where the consumer's been okay so far is you really haven't seen the employment data change. In other words, John, and this is a broad range, so I kind of laugh when I say it. It's estimated that a rate hike takes between 3 months and 18 months to affect economic output. Let's just use the 3 months. Let's make it the most aggressive. That means that we're only beginning to discount the beginning of the rate hike cycle. We've now got 275 basis points, a possible 50 or 75 basis points in September. They haven't really filtered down into economic output. We've got a doubling in the mortgage rate. The average home price has also doubled over the last couple of years, or it's up pretty significantly over the last couple of years. It's just not a great setup for the consumer, even though the data, because it's the end of March, suggests that it might be.
Tony, we've known each other a long time, so I'm sure we've explored this before, but let's explore it again. Isn't the labour market a barn door data point? Once you get there, hasn't the horse already bolted?
Of course. That's, John, as you know, we've been talking this whole year about the Fed being in a box. They put themselves in a box. They're using two lagging data indicators. They're using inflation and they're using employment. And both of them are lagging data indicators. If you look at like I said before, the percentage of the yield curve is inverted. We're going into recession historically. If you look at just about any other major economic data point, it's pointing toward a recession. Not now. It's been a strong economy because companies could pass through their cost. Incomes were going up. The issue is not now. The issue is what happens going into early 2023. And again, I just want to make it very clear because we don't do it enough. There's a difference between the economy and the market. The stock market's getting hit. The unemployment rate is rising aggressively. And inflation is coming down. By the midterm elections, I expect there to be some kind of pivot or better statement out of the Fed that they're getting more successful that could allow us to hold the lows.
As you've said, Tony, that's just not tradable right now.
It's just one of those times, John. I would love to make an immediate, let's do something on the next tick. This whole year is about, until we got oversold as we were in May and June, now it's in the middle. The intermediate term indicators are no longer overbought. They're in the neutral zone. Short-term indicators are getting oversold, and it's very unclear what's happening with interest rates. So, or meaning market-driven interest rates. They've already moved up.
Yeah.
So I think it's just a time to sit tight and react versus try to get in front of it.
Tony, I appreciate the absence of a hard sell this morning. Thank you, sir. Tony Dwyer there of Canaccord. Coming up, the Trading Diary. That's next. This is Bloomberg. About 26 minutes into the session this morning. Good morning to you. Your equity market losses are marginal, mild, small. We're down about a third of 1% on the S&P. On the Nasdaq, down 0.2. Let's get to the trading diary. We look a little something like this. A little bit more Fed speak. We'll hear from the Vice Chair Brainerd at 2:15 Eastern Time. You'll hear from Barkin and Williams on Tuesday, followed by consumer confidence numbers out of the US and Europe. European CPI and remarks from Fed President Mester on Wednesday. ISM manufacturing and initial jobless claims on Thursday. And then the main event on Friday. His payroll's just around the corner. From New York City, it's good to be back in New York. Thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.